Mortgage rates just gave us a perfect lesson on why only watching the Fed can be very misleading. Rates started this week around 6.60, improved after inflation data came in better than expected, jumped after the Fed meeting, and then ultimately recovered yesterday to close the week at 6.58%. Yes, market is closed today in observation of Juneteenth. So let's dive into what happened on this wild roller coaster of a week. So, jobs data showed again that the labor market is stronger than expected. Both CPI and PPI came in better than feared. Inflation data, mind you. The Fed met this week, and yes, they left rates unchanged, but signaled they could hold rates higher for longer. Markets initially sold off after the dot plot turned more hawkish, meaning, hey, we could see rates actually rise. Markets did not like that at first. But investors later digested the meeting and shifted focus back to improving inflation trends. A US-Iran agreement was inked and signed, and it helped push oil lower, easing some of those inflation concerns. Pending home sales jumped to 3.8%, showing buyers are still active despite higher interest rates. So the biggest takeaway, yes, the Fed did not cut rates this week. The Fed was actually more cautious than we expected. Yet mortgage rates still improved by the end of the week. That's because mortgage rates, they're driven by inflation expectations, bond markets, investor sentiment, and not just Fed announcements. For buyers, sellers, realtors, loan officers, the message remains the same. Demand is still there. Inventory is improving. And trying to perfectly time rates remains one of the hardest strategies in market. If you'd like to help understanding how today's market impacts your buying or financing options, reach out to us. We're here and would love the opportunity to serve you and your clients. As always, let's make it a fantastic Friday and an even greater weekend.